makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. European and Asian stocks rise ahead of a U.S. CPI data, which is expected to slow but stay above the Fed's 2% target. UK wage growth slows and vacancies continue to fall, but not as much as expected, complicating the BOE's inflation conundrum. Plus, Glencore gains as the commodities giant buys a majority stake in Teck Resources' coal business, ending a months-long saga. So there's plenty of news going on. Happy Tuesday, everyone. This is what the European markets map is telling us. And again, a lot of the focus will be, of course, on those CPI figures a little bit later on. So stocks for the moment seem to be a little bit stuck. Maybe they're a little bit on hold before the U.S. inflation report. If you look at miners, the best performers in Europe's Stock 600, Glencore, we're just telling you about Glencore leading the gains after agreeing to buy this majority stake in Teck Resources. A lot will depend on inflation. If it does moderate as predicted, that may help cement the notion that global interest rates are peaking. The other story we're watching out for, of course, is oil. Now, I'm looking forward to our interview with Toril Bosoni of the IEA shortly. At the moment, oil markets, they're coming out with their report saying that actually oil markets is a little bit less tight than expected. This is as supply is actually climbing. So we'll get through the report. For the moment, you can see WTI over in New York, actually at 78.43. Now, joining us now, as promised, is the IEA's head of oil markets division, Toril Bosoni. Toril, as always, thank you so much for coming on. I know it's a busy day because you release it and then you make the time to come and speak to us. When you look at oil price actually slumping to a 3-month low last week, what has been the biggest impact, Toril, on some of these prices? Is it weaker demand or higher supply?
I think it's a combination of both. We're seeing, obviously, the macroeconomic sentiment is deteriorating. There's a lot of concern about interest rates and slowing growth. But what we're seeing is that oil demand is actually holding up strongly and exceeding expectation, as we note in our last report, especially China going from strength to strength. In September, Chinese oil demand was at another record high, above 17 million barrels a day, despite the bleak economic outlook. And we're seeing also, as you note, that supply from non-OPEC producers are exceeding expectations, with strong growth from the United States, Brazil, and other countries. So a combination of the two has eased the tensions in the market for the time being.
So, Toril, when you look at demand, has demand gotten worse recently? And if yes, where?
We are seeing some signs of demand destructions. As I note, China and the U.S. has held up relatively strongly despite the economic outlook, but we're seeing signs of slowing demand, especially in Europe and also in OECD Asia Pacific, where in the third quarter demand fell by more than 500,000 barrels a day. We're also seeing signs of weakness in a number of African countries and globally. Really, the strength that we're seeing in demand at the moment is concentrated in a handful of countries. China, India, Brazil account for more than 90% of growth in 2023. And China, by far the biggest contributor, with more than 3/4 of the growth. So a handful of countries are driving the strong demand rebound that is coming out of the COVID pandemic. Jet fuel, China is driving growth and weakness in a number of other countries.
Toril, there's a couple of things that, and as we get into the report, so you've once again increased your demand forecast, right? You see growth of about 2.5 million barrels a day this year, but you're also predicting demand growth will actually slump 60% next year. So how do the two match up?
As I noted, the growth this year is really concentrated in a handful of countries, and this is China's rebound from the lockdowns that they had in 2022, and also jet fuel recovery from those lockdowns, not just in China, but globally. So a lot of the growth this year is exceptional, and it's a rebound rather than underlying structural growth. So as that recovery runs out of steam, as we're seeing now, we expect the structural factors factors to come into play. Energy efficiency improvement, increasing EV sales, and also the weaker economic outlook projected for next year will take its toll. So we're expected to go back to trend or below trend demand growth from next year, and we're already seeing this demand slowing at the moment.
What are you expecting OPEC Plus to do? Many analysts think that they'll extend their 1 million barrel a day cut. Would that be a mistake?
So that's for OPEC Plus to see, and Saudi Arabia. They're obviously looking at the market very closely as we are. What we are seeing now is that the market is in deficit. We're seeing demand surpassing supplies in the fourth quarter, and we're seeing significant stock draws. That could shift into a surplus in 2024 as demand slows structurally and seasonally at the start of the year, and if those cuts are maintained. But with inventories at crude oil inventories are at the lowest level that we've seen in our records, and the general inventory positions very tight, a return to surplus will be welcome for the market to reduce volatilities in the month ahead.
Toril, when you look at some of the analysis that we've had recently on Russian oil, it seems that some of the Western sanctions are not as working as efficiently as some initially thought at the start. So how do you see it developing?
So now it's true, Russian exports are holding up. In October, Russia exported 7.5 million barrels a day. That's still about 500,000 barrels a day less than they were before its invasion of Ukraine. But we're also seeing revenues creeping up as oil prices have increased, and the discount that Russia is getting for its oil narrowing from close to $40 after the invasion to less than $10 now. So obviously there's pressure on the international communities to reduce the revenues that Russia is getting from its oil. But we're seeing that with oil, increasing volumes of oil moving to destination outside of the EU and G7 countries and moving on maritime services outside of those jurisdictions, we are seeing that the discounts are narrowing and the sanctions in place are having less of an impact on the price of the Russian oil.
I think, Toril, also when you look at some of the diesel demand in Europe, it's weaker because of weak economy. How does that develop going forward?
So it's true. In Europe, oil demand in the third quarter is down almost 500,000 barrels a day from a year ago. And most of that weakness is coming from the diesel market, but also from naphtha. So two fuels that are closely linked to industrial activity and manufacturing. And that has helped ease some of the tension in the diesel market. But even so, the inventories are low. The loss of Russian diesel and euros to European refiners means that the European diesel market is tight. So now Middle East has come up as the largest supplier of diesel to Europe at the moment. And with those flows slowing in the recent months because of maintenance in the Middle East, there is concern about meeting the winter demand in Europe in the coming months. And if we don't have a repeat of the warm winter weather that we had last year, we could indeed see that the market getting even tighter in the months ahead.
All right, Toril, thank you so much, as always, for joining us. Toril Bosoni, they're head of the oil market division of the IEA. Now, we also got some breaking news of Glencore, one of the biggest gainers in today's trading session after it agreed to buy a majority stake in Teck Resources' coal business for $6.9 billion. Now, this is ending months-long saga and also setting the stage for the commodity giant to spin off its own coal unit. You can see Glencore gaining 3.2% intraday, and we also have Teck Resources pre-market up 4%. Now, coming up, fresh data out of the UK. Wage growth slows and vacancies continue to fall, but not by as much as expected. So we discuss that next, and this is Bloomberg.
The man who called and lost the Brexit referendum is back in government. In a surprise move, the former Prime Minister David Cameron has been appointed Foreign Secretary by the current PM Rishi Sunak. So here's a look back at Cameron's record in office. Facing a hung parliament in 2010, Cameron led the first coalition government since the Second World War, joining forces with the Liberal Democrats to become Prime Minister. His first major foreign policy test came in 2011, when Britain played a central role in NATO's bombing campaign in Libya. That helped to topple the Libyan leader Muammar Gaddafi, who was violently clamping down on protests. But the country since slid into brutal civil war and remains divided to this day. In 2013, Cameron failed to secure Parliament's backing for airstrikes against the Syrian leader Bashar al-Assad, who was accused of carrying out chemical weapons attacks on opposition forces. Cameron was also the Prime Minister who invited the Chinese President Xi Jinping to the UK, famously taking him down the pub for a pint. And relations with China are an issue that could catch up with him now he's back as Foreign Secretary. Cameron confounded expectations, winning a narrow Conservative majority in the 2015 general election. His key pledge, an in-out referendum on the UK's membership of the European Union. Cameron, who led the Remain campaign, faced off against Boris Johnson and Michael Gove in that referendum. He'd already notched up 2 referendum victories, first against voting reform and then against Scottish independence. But Brexit was a surprise defeat for Cameron, who promptly announced his resignation.
Bloomberg's Alex Morgan there looking back at David Cameron's record in office after being appointed as the UK's Foreign Secretary. So there's a lot to talk about. Also sticking with the UK, wage growth slowed and vacancies continued to fall, but not as much as expected. Now, these are further signs that the labour market is actually easing as the British economy flirts with recession. Joining us now to discuss the data, but also to discuss the politics, Themos Fiotakis, head of FX research, Barclays, and Bloomberg's Adam Blanford. So thank you both for joining us. Adam, there's still this obsession, and I was at a couple of events yesterday about what David Cameron brings to the Tory party, what it means for the campaign, and actually just what it means on foreign policy.
Well, on foreign policy, that's obviously his new core brief, and it'll be very interesting to see where he goes on contentious issues like China, where the lay of the land has changed quite a lot since he was in power. You heard the package there talking about his outreach and his sort of friendly posture with Xi Jinping. Obviously, the US is much more sceptical of China now, and there are the winds within Parliament have changed quite considerably, with a lot more friction between on security and national security issues. On the EU, it will be intriguing to see how Cameron goes back into the negotiations with the EU after the Brexit saga, and of course he's taking over at a time when there were 2 wars raging, Russia's war in Ukraine and obviously the conflict in the Middle East. So there's plenty there for him, but he's being pitched by the government as a capable, confident pair of hands who's been there and done it before. What will be interesting is to see whether that plays out with the voters who, he has had a record in office.
Adam, so basically, I mean, what would make a success of this new cabinet? Is it if Rishi Sunak and David Cameron get along and there are no waves? But, David Cameron is a big personality, so I don't know whether there's always a danger that he steals the limelight.
That's true, although he's had his time as Prime Minister. Presumably, the mission has been agreed here that success would clearly be for them a creditable performance in the election. We can discuss about what that might mean, whether they're truly thinking of winning. But of course, the bullish outward statements will be that the Conservatives are trying to win an election by bringing back an elder statesman and a heavy hitter from the past.
So probably this should have moved pound more than it did, Themos.
It may. There's still time ahead. I'd like to pick it up from a key point. I think the market soon, at some point early in 2024, will start looking at the election in the UK.
Right.
And I think that there's been a considerable shock to trade and to prices from Brexit. Public opinion has taken stock of that. You can see that in many, many surveys. The opposition has taken stock of that in how they're discussing their own kind of agenda. And I think the government is now starting to think about how to adopt a line that will generally try to moderate, to assume the right kind of stance in terms of trade.
But so, Themos, what does it mean? If you look at sterling, right, from where it's now and where it will be, everything probably put in place by the cabinet and the government now will be trying to win the election. What does that look like? Is it more support to households that need it? Is it more kind of middle ground to make sure that they really go against labor? And what does it mean for sterling?
Well, that's the important point. I think that ever since 2016, the pound has been in a range against the euro between 85 and 90. We have seen periods of time of strength, economic strength, have seen periods of time of economic weakness. It has traded weak to the euro. A big reason for that is the trade shock that we have experienced here and the price shock that we have experienced, supply shock. And I think that a key point for the pound is how do we create a trade setup, a positive supply shock in the next 4 years. And I think the closer we move to a degree of pragmatism in terms of carving out better supply situation from trade, it's going to be a positive for the pound, which is also what we think the market will start expecting and what we have in our new forecast published this morning, with euro sterling driving down to 84 next year at the end of next year.
And Themos, I want to ask you about the UK labour market data in a second, but overall, Adam, what do we know about what the priorities for Rishi Sunak are now? So obviously it's domestic, the economy, so that's the Chancellor, but then it's foreign policy because of everything that's going on in the world, the second most important thing to him.
That's right. There's those priorities he has. There's clearly a situation in the Middle East where the UK is aligned with the US, and that there's a worsening conflict that they want to stop worsening there. Cameron will have issues with China. The Foreign Secretary has involvement in everything from the range of from the AI conference to upcoming business and investment conferences with in the UK. So there's a broad range, but it's extremely interesting. Although James Cleverly, who's moved out of the Foreign Office, is into the Home Office, is quite has been seen as a creditable and well-performing minister. It's interesting to see what the change of tone might be, having moved Suella Braverman, who was divisive and some say controversial, out of government, and whether the Sunak administration will be trying to project a different public posture by bringing Cameron back in. It will be very interesting to see how it goes, because the last few months have seen quite a few different changes of direction.
Yeah, it certainly has. Themos, when you look at the UK labour market, look, it's holding up better than expected. I don't know whether that's something that needs to be applauded. In terms of what the market is expecting the BOE to do, it hasn't really moved that much.
Yes.
Because it's also a very tight labour market.
Yeah.
So it's still, maybe it's more of a construction problem of how, employment is behaving in the UK.
I think there's definitely some structural problem in terms of low supply and a pretty big gap in terms of the jobs needed versus the jobs supplied. But I do think also that we're starting to find out globally that the trade-off between inflation and labour market is much less onerous than we thought in the beginning. And the UK is still due some disinflation down the line, given global trends. So I think that, the Bank of England is striking an appropriate kind of a message where they're trying to see the impact of their actions on prices without necessarily being too pessimistic on the labour market, which I would agree with.
Okay, Themos and Adam, thank you so much. Adam Bluntford, they're looking at all things politics, and Themos Fiotakis staying with us, because after the break we'll also look at pressure on the yen with U.S. inflation figures out a little bit later. So a full FX roundup, that's next, and this is Bloomberg. Well, yen traders are bracing for U.S. inflation data, which could push the currency to a 33-year low and trigger government intervention. Yesterday came within a whisker of levels that saw intervention last year. Well, we're still with us, Themos Fiotakis of Barclays. Themos, when you look at yen, first of all, thank you for sticking around. When you look at yen, I mean, this is like more than an experiment. This is the hardest job in the world of central banking right now.
I think that there's definitely conflicting goals between the Ministry of Finance, the central bank, etc. What I would say is that the strong dollar is probably here to stay for at least another 9 months. And I would say also that if the yen moves in an orderly way, they have said as much to everyone that it's not about the level, it's about whether it moves with everything else. So we're not going to be seeing a heavy hand from them unless it moves in a disorderly way. If you add on top of that they will be adjusting their policy, the central bank policy, but only very gradually, it's very unlikely to change this huge negative carry in the yen, which is a big negative factor for the yen. So overall, I think while it's shifting there in a painful way, it will probably break through these levels and move on to 153 or so.
Okay, overall, what does dollar do? So we're expecting the CPI, but this is, of course, this changes everything for all emerging markets.
Yeah. So I think that the CPI, it's probably going to be slightly higher than the previous readings. There's also this underlying trend that because of used cars and other sort of like disinflationary items abating towards the end of the year, that we might see a couple of strong prints as well. But I think that the bigger underlying point is that the US has been a leader in disinflation, and now you're probably going to see other G10 catch up to the US while the US stabilizes in a slightly higher inflation. At the same time, the US will continue to operate well above capacity for the most of next year, while other economies, including Europe, will probably start operating slightly below capacity, which will mean also that this convergence that is priced as interest rates is probably a little bit too optimistic. It will happen, but it will probably happen in 2025. So if you put that all in, we have revised our forecast for a stronger for longer dollar, with the euro dollar going to 105 until the middle of next year.
Themos, thank you so much. As always, Themos Fiotakis there, head of FX research at Barclays. Of course, plenty more on US CPI after the break. This is Bloomberg. European and Asian stocks rise ahead of U.S. CPI data, which is expected to slow but to stay above the Fed's 2% target. UK wage growth slows and vacancies continue to fall, but not as much as expected, complicating the BOE's inflation conundrum. Plus, Glencore gains as the commodities giant buys a major stake in Teck Resources' coal business, ending a months-long saga. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So traders, of course, bracing for the U.S. CPI print out later today. Now, Bloomberg Economics says it's likely to show slower progress towards the Fed's 2% target, keeping the central bank biased towards more tightening. Now, core CPI probably gained 0.3% month on month, leaving the year-on-year rate unchanged at around 4.1%. Now, let's discuss all of this and, of course, this rates environment with Giuliana Bordigoni, Director of Specialist Strategist at Man Group. Giuliana, as always, thank you so much for joining us. I know a lot of the conversations that you're having with clients is basically about these higher interest rates, where they end up, and actually what it means for the underlying economy and businesses.
Yeah, definitely we have seen higher interest rates that we have seen in more than a decade. And we are seeing the impact in few asset classes of these interest rates. Like one obvious impact is in mortgage rates. We are seeing mortgage rates in the US at the highest since early 2000. They are at about 7.7% rate. That they might have impacted the economy via the fact that people are not quite moving home because they need to refinance, and obviously refinancing is expensive, which means that if you have to take a job from another place, you need to put that into consideration. So that might have an impact in the economy. The other part where we are seeing the impact is obviously corporate borrowing. So corporations have put themselves ahead and they have tried to borrow on the longer term for many years when the rates were lower. But still we have about 3 trillion of debt that is coming into maturity within the next 5 years, which is a really chunky number. So we'll have to see what that means in terms of stress to corporations. At the moment, we are seeing default rate going up. Moody's estimates them around 4.5%. But what I'm trying to say is that they are up, but the situation is still fairly benign.
Yeah, which I'm surprised about. I don't know whether it's something that you surprised. I mean, you're really in the markets. You look at, quantum analysis. You're speaking to clients. Would you not have expected to see more distress to where we are? And, how difficult is it to explain this?
I think that the reason why the situation is not so distressed, I mean, in the mortgage space is because, as I said, the house prices have kept high, and they have kept and they have kept high because there is little supply. On the corporate side, as I said, there has been provision through the years in order to make sure that to borrow when rates were lower for a bit longer time. And in general, you can see that corporates are a bit less levered than we are talking about in 2007. Now, obviously, it's a very different scenario. And when we talk about it, we always talk about, oh, this is like the highest that we've seen in 20 years, or is the highest rate that we have, the Bank of England. There was the headline earlier, the Bank of England rate is the highest in 15 years. So the point of is like that makes it the job of the quant that can't rely anymore just on backtest. So normally, when we build strategy, we think about the backtest, we look at what happened in the past. That's not enough. We really need to incorporate what we think is the outlook, what we think is some realistic assumption in our model. That is really the major change.
Giuliana, when you look at COVID, has it changed, everything? Because people were saving, and I guess behavior has probably changed at the margins. I don't know whether it's changed enough to look at actually how corporates and also households behave.
I think, from my point of view, and I'm a quant, right, at the end of the day, but I think from my point of view, interest rates have changed more than the actual impact of COVID. So if you look at the impact of COVID, there is still some of it. I think that if you look at in the US, I think that US house supply is not as high, but not just from the household point of view, even from the construction point of view. We are not back at the pre-COVID level. But I think that what we are seeing from my point of view is really the impact of high rates.
When you look at, so what are your clients asking? I mean, a lot of the questions surrounding that, but are they asking also, are they looking at the models and asking you specific things that they wouldn't have asked a year ago?
I think that the major question we are getting is about cash efficiency. I think being cash efficient is more important today than it was when there were low interest rates. So that is the major topic that we are seeing at the moment. Obviously, now you have the performance of the fund versus a 5% rate. And that is the major point of discussion.
And that's actually going to be the case for the foreseeable future, right? Until interest rates start going down, which could be a long time away.
Well, if you listen to most of the banks, the central banks, they are saying that interest rates are there for longer. So yeah, it's going to be the case for a while. Yeah.
And Giuliana, when you look at some of the quant analysis, how do you tweak it from, if not country to country, like region to region, because of some of the peculiar dynamics, I guess?
So I think that what we try to be robust, right? So when I was telling you about the back test and what I was telling you about looking forward, is really about building a robust model. And the more robust model is the one that works in different regions. So we really try to, obviously there are some region-specific effects that you may want to capture, but I think that the main idea is trying to be robust across regions.
I mean, you've worked actually in quants for quite some time, and I think you came on about, I think last year you came also on the program, we were talking about it for the first time. How has the models changed? How has it developed, and also client appetite for understanding this changed?
So I think that when I started, there was a lot of trend following, and loads of the research was about diversifying trend following across markets. So going back to your question, it was an effect that was present in many markets. We were trying to diversify across all the regions. Now what's changing is that we are looking more at effects that are non-trend following, and that they can diversify in terms of the signal. So it might be still across region, but it's not necessary, and it's really more about that. In fact, you can think of this year, one of the styles that has worked has been equity market neutral effects, and that has been one of the best performers this year.
But is that because the market is more complicated, or just because quant analysis has become better, more advanced?
I do think that we advance, right? I think it's more about advancing, it's more about improving signals and so on. But obviously there has been major changes in the market. We discussed earlier credit, right? Credit is one of the markets that has become more electronic, has become more automated. And that obviously has changed the dynamics, has made it possible for quants to enter into that space that maybe 10, 15 years ago was more challenging because it was all voice traded.
Yeah, that's such a good point. Is there any other part of the market that you're expecting quants to become bigger because the way the behavior of the market is actually changing?
I think that at the moment the focus of quant has been in the very liquid markets, right? I think that there is going to be more presence in the market that are maybe less liquid. That's what I see in the future. But the liquid market will be always the easier part for quant to trade.
Well, I don't know about easier, but certainly you do it very well.
Well, I mean in terms of like liquidity, right? So let me explain what I meant by easier. So what I mean is that when you go into credit, just to stay on the topic of the credit that we touched earlier, you are not sure if you're going to be able to execute. You need to put loads of assumption in. Am I going to be able to trade this bond or not? When you are in the liquid space, you don't have that problem.
Yeah, you have the data, so at least you can do the job of analyzing. Giuliana, thank you so much for joining us today. Giuliana Bordigoni, their Director of Specialist Strategies at Man Group. Now, let's also get you some of our other top red stories on the Bloomberg terminal this morning. And officials from the Industrial and Commercial Bank of China are said to have flown to the U.S. in an effort to contain fallout from a cyber attack last week. The world's largest lender is looking to reassure markets after a hack by ransomware group Lockbit prevented the ICBC from clearing numerous U.S. Treasury trades. Now, the bank is investigating the incident, but has not announced when access to systems of its offshore unit will return to normal. Google is paying Apple 36% of its revenue it earns from search advertising made through the Safari web browser. Now, the figure was revealed by Alphabet's main economics expert, Kevin Murphy, in testimony he gave in Google's defense in an antitrust trial in Washington. The partnership dates back to 2002, when Google became Safari's default search engine. And then unionized Starbucks baristas, that's something that's close to our heart here at Bloomberg, are planning to hold their biggest strike yet this week. Now, thousands of employees at hundreds of U.S. sites will walk off the job on Thursday, accusing Coffee Giant of refusing to fairly negotiate at cafes that voted to organize. Well, Starbucks maintained that it is the union that's refusing to fairly negotiate. Now, some other breaking news that we're having, this is actually just crossing the Bloomberg terminal right now. China is mulling $137 billion of new funding to boost the housing market. This is one of the measures that China has been putting in place to try and support the economy. Now, coming up, the push for safer AI. We ask Appian Chief Executive Officer Matt Calkins if the right people are regulating artificial intelligence. That's next, and this is Bloomberg. Now, NVIDIA is updating the processor that has fueled its dominance in the AI computing market. The company says a new model called H200 will use high bandwidth memory to better cope with the large data sets needed for developing and implementing AI. Now, large computer makers and cloud service providers are expected to start using it in the second quarter of 2024. Now, my next guest says we're asking the wrong people to legislate on AI. Well, joining us now is Matt Calkins. He's the Chief Executive Officer and founder of the software development firm Appian. Matt, thank you for joining us. So who should we ask to regulate AI?
We should not ask big business. We should start asking the content developers. The biggest threat to me right now in the development of it, the regulation of AI, is protection of our data. So I want to talk to the people who create the data that's at threat. And that means artists, musicians, authors, people who have private information that's being trained on today. Their voice needs to be heard, and today we're talking mostly just to big business.
So, which we're regulating more in Europe than we are in the U.S. Who's getting it right? I mean, the Commission has, GDPR, like things like that, and trying to put in place to safeguard it. Should they do much more with AI?
Look, I appreciate the direction that GDPR goes in. It's about protecting individual data, but I don't believe it's been successful. I think the right way to do this would be for the government to intermediate between the inevitably lopsided contracts that occur between large organizations and individual people. You have to get in between that and say, for example, every person should be able to set the price of their own private data, and now it's up to big organizations whether they want to buy it, as opposed to every person now has to choose yes or no to whatever terms that a large organization puts at them.
But, I mean, Matt, this basically changes everything, right? If that's the case, then it becomes much more government or regulation heavy. And a lot of people don't really, when they sign a contract, fully understand what data they're giving away.
Right now, we all sign contracts with major internet service providers every day. We just click through and we say yes because we're at a great disadvantage. We don't know what these contracts mean. If the government were to intermediate and say now the contract means every person just sets the value of their data, now we would have a heavyweight on both sides. And today we have a heavyweight only on one side. And so I'd like to see a development like that. Neither government is today getting it right, and I don't believe that GDPR's efforts have been successful in protecting private data.
But Matt, just so I understand, this is not because they're using the data in a nefarious way. It's just because we're giving data free.
You know, honestly, in some cases it is being used in a nefarious way. There's a lawsuit by hundreds of authors today claiming that their copyrighted material was used to train AI algorithms, and from what I can tell, they're correct. They're correct. And the latest recommendation coming out of the White House says that AI can be trained on any of this information, provided it is anonymized. To me, anonymizing my private information when it's used to train AI is not enough. I want my information to be defended, not merely anonymized.
Do you think that AI will go much faster, the development of AI will go much faster than we think it will, or much slower?
I'm expecting the development of AI to slightly plateau in the next few years. There's two things that improves an AI algorithm. One of them is the amount of data we feed it, and the other is the mechanism by which we translate that data into effectiveness. Now, we've largely fed everything we can into today's modern AI algorithms, and so we have to switch our focus to the harder problem, which is converting that data into effectiveness. And you'll see that proceed rather slowly, and so I think there's going to be a bit of a plateau in the next few years.
So how do you think it will be used? And when we talk about effectiveness, but this is, what does this look like? Is it job losses? Again, there's like worst case scenario, there's, you know, better case scenario, but it's unclear where we end up.
Yeah, I don't think it's job losses. I think we're entering an era of mixed autonomy where AI is a complement to people instead of a substitute. I think the AI has shown that it can't be a substitute. The hallucinations, the problems, it's not going to be able to do this all the time. And if you look back 5 years ago, we would have been anticipating that AI would be driving our cars right now. Yeah. And we know that it's not, because an algorithm that makes a mistake 1 time in 1,000 can't drive our cars. And so instead, we've realized that AI is dependent on humans in order to make a good answer, and therefore we have a part to play for a long time. We're going to be empowered by AI. I don't think we're going to be replaced.
But I was in Singapore last week at our New Economy Forum, and actually we had this wonderful panel on, you know, putting people at the front of businesses, and it's probably never been more relevant than it is now. So instead of regulating through governments, why not go back to labor unions?
Labor unions, did you say, for regulating how we should use AI?
For regulate how you use data. So if you have the union, for example, of musicians in the U.S., how much pressure can they put? Does it achieve the same kind of regulation that you're talking about?
A union essentially gathers the power of a number of people and provides a counterweight against the power of a corporation. That's one way to counterweight the corporation. Another way would be for the government to say, well, the way we should do this is everybody sets a price. Yeah. As a musician, if I wrote a song, I'd like to be able to say, AI can train on this song for $1,000. Or 10,000 pounds or whatever amount it is, and then let the AI algorithm make that decision. Ideally, I think that's how it should work, and you wouldn't need a counterweight because the government would already be one. But there's many ways to approach this, and the union approach could work as well. Yeah. I just want to be sure that we're not all helpless in the face of a giant organization putting a contract on us.
So who's thinking about this? Who's doing it right? Is there one government or one politician that you think gets it?
I don't think they're getting it. I think that the statements that came out of Chuck Schumer's office, that came out of the White House, that came out of Bletchley Park, while all promising in different ways, none of them targets the fundamental issue right now, which is the privacy and safety of our individual data and what we create. I don't think anybody's focused on that, and the reason is the industry is absolutely not focused on that, and they're guiding the conversation in a way that's suitable for them.
Matt, thank you so much for joining us. Matt Calkins, the Chief Executive Officer and founder of Appian. Now, coming up, Presidents Biden and Xi are set to announce a deal that would crack down on fentanyl exports when they meet in San Francisco tomorrow. So we look at what traders are looking out for next. This is Bloomberg. U.S. President Biden and his Chinese counterpart Xi Jinping are set to announce an agreement that would see Beijing crack down on the manufacture and export of fentanyl. Now, the two are due to meet tomorrow in San Francisco on the sidelines of the Asia-Pacific Economic Cooperation Summit. Now, let's bring in Bloomberg's EMEA News Director Ross Matheson. So, Ross, thank you for joining us. What are we actually expecting on this fentanyl deal?
Well, it's interesting to see that there might actually be movement on this because the US has been pressing China for many, many months to try and improve the situation when it comes to the crisis around fentanyl in the US, because China, of course, has the raw materials and the fentanyl that somehow seems to find its way through Mexico and into the US. So it's a very complicated situation, but at least sort of trying to cut it off at the source. And so far, China had seemed resistant to that. Now we're hearing there's going to be an agreement, at least a promise, to try and curtail the supply of fentanyl and its source material from China. At least whether that turns into reality may be another thing, but a promise to do so. And that's a really important development for US President Joe Biden coming into the election cycle in the US. Of course, the fentanyl crisis is severe in the US. It's something that he's promised that he wants to tackle, and successive presidents have tried to tackle and been unsuccessful in stopping. And so for Joe Biden, it's quite a goodwill gesture, really, from Xi Jinping, and a potential positive for him going into the election.
So Roz, this is something that the US need, especially President Biden. What does President Xi want?
Well, he wants, he wants the meeting with Joe Biden to begin with, and that kind of being seen to be greeted in the US, treated on an equal footing by the US president. But also he needs things to be put on a better keel with the US because he's got an economy that's struggling, and he needs to stabilise that. He needs to stabilise his economy, his markets, his companies, and therefore his ability to hold on to power in China. So what he's seeking is actually just to sort of put a floor under the tension. So you're seeing these goodwill gestures, perhaps fentanyl. China's also buying soybeans now from the US. We won't see big breakthroughs either way, but at least, an understanding that the business ties between the two countries won't get any worse.
And that's, I guess, a win on both sides as we get into the election, year in the U.S. But there's nothing on chip makers, or could there be an escalation on foreign policy, or getting China to get more involved in the Middle East?
We're going to see cooperation on certain things where they agree they can cooperate, like, again, climate change, the gestures around fentanyl. China, it's an easy win for them to just buy some soybeans from the US. On the really hard stuff, like trade, technology, we're not going to see a lot of movement, potentially, but at least we're going to see some of the tension, the overall tension, dissipate. You'll expect the US will push China to take a stronger stance on things like the war in the Middle East, obviously between Israel and Hamas, and criticising Hamas, which China has not done, perhaps a firmer stance again on Russia over Ukraine. But those are things that China really does not want to get seriously involved in.
Does China want President Trump or President Biden at the next election? Do we know?
Well, that's the big unknown, actually, for a lot of countries, and not just China. At least with Joe Biden, you've got someone who's sort of more reliable, consistent. You can negotiate and deal with a presidency under Joe Biden because you know what to expect a little bit. It's a known known. With Donald Trump, it was obviously very erratic. He could change his mind on a given day. One day he would be speaking quite warmly about China. Next day he's in a trade war with China. So much, very unpredictable, and the Chinese don't like unpredictability. So it's hard to know, but, you can imagine that they'd say at least with Joe Biden they've got consistency.
Roz, as always, thank you so much for joining us. That was our Bloomberg EMEA News Director, Roz Matheson. Now, Sotheby's also sold, in other news, a rare 1962 Ferrari for nearly $52 million in less than 20 minutes. Now, it is the most expensive Ferrari ever to sell at auction, and the most expensive classic car sold publicly anywhere in the world this year, though the final sale price was lower than expectations. Now, it's also the only factory GTO Tipo 1962 to have been raced by Scuderia Ferrari, the automaker's Formula One division. And the Ferrari chief executive, Benedetto Vigna, actually features on this month's episode of Leaders with Lacqua, and that premieres next week. Don't miss it. It's a good interview, and we also talk a lot about going green. Now, also a lot of important conversations throughout the day today, including our exclusive interview with the Citadel chief executive, Ken Griffin. That's 6 p.m. London, 1 p.m. Eastern time, and this is Bloomberg.